Welcome class. Today we'll discuss chapter 17, the cash flow statement. We are using the accounting principle, 9 editions. This is prepared by Debbie Mossels, FCPA, FCMA. It is by copyrights owned by John Wally. Class. We're going to start. We're going to start soon. In this particular chapter, we have 4 objectives. Learning objective. The first one, discuss the usefulness, content, and the format of the cash flow statement. Okay, prepare the cash flow statement using indirect method. And number 3, prepare the operation section of the cash flow using the direct method. And 4, analyze the cash flow statement. Cash flow statement, the reporting cash flow statement, usefulness and content of the cash flow statement. Preparing the cash flow statement using 2 methods, indirect and direct method, and using the financial statement information of free cash flow. Let's jump in right away to the learning objective number 1, which is the usefulness, content, and format of the cash flow statement. Okay, what are the usefulness? Let's look at the details. It gives information about the cash receipt and payment, net change in cash during a period, help the investor and creditors to understand the company, ability to generate future cash flow, ability to pay dividends and meet obligations, investing and financing transactions during the period, as well as cash provided for operational activities, how it differs from the field. In terms of cash flow statement definition of cash flow statement is prepared using cash or cash equivalent, is highly liquid investment readily converted to cash and very near maturity, usually within 3 months of maturity. And company must give a clear definition of cash as it is used in the statement. Content of cash flow statement is a clarification of cash flow. In terms of operating cash activities, is cash affect transaction that have created any revenue as expenses related to changes in non-cash current assets and liabilities. Investing in activities such as affect non-current assets, buying and selling long-lived assets, buying and selling long-term debt and equity investment, lending money, and collecting the loans. In terms of the cash flow classification statement, it's contained in terms of financing activities. There's an effect of non-current liabilities. In terms of shareholders' equity accounts, such as obtaining cash flow from the issuing debt, okay, and using cash flow to repay debt, and obtaining cash from shareholders, and paying dividends. So these are the things of classification that we are seeing. And then the guidelines, in terms of preparation of guideline exceptions, reporting of interest of dividend is different from entities under IFRS and SPE. Again, IFRS is International Financial Reporting Standard. Is the standard here in Canada being used. Okay. Interest and dividend received may be classified as operating or investing activities. Interest and dividend paid may be classified as operating and financing activities. Under SPE, interest received and paid, dividend must be classified as operating activities. Dividend must be classified as financing activities. In terms of operating activities, here the income statement here, and the balance sheet, that's current asset and current liabilities. This is operating activities. In terms of investing activities, will be balance sheet, and then the long-lived assets. For financing activities, will involve balance sheet, which is non-current liabilities, as well as shareholders' equity. These are the classifications. In terms of the significant or non-costly activities, in terms of investing and financing activities not affecting cash are not reported in cash statement, reported in separate note instead. Examples such as issue debt to purchase asset, issue common shares to purchase assets, conversion debt or preferred shares to common shares, as well as exchange property, plant and equipment. Okay. What are the cash flow? It can be indirect or direct. The indirect one is more popular. Is total profit is adjusted for the item that do not affect cash. This is the most popular one. Total profit adjusted to the item that do not affect cash. Direct, based on individual revenue and expense, and are adjusted from accrual to cash basis by showing operating cash receipt and payment. Affect of transaction only. Both methods arrive at the same total amount. Different is the amount of disclosure. This is an example of the format of the cash flow. Okay, for the carry period, cash flow from activities, this is the one. Inflow and outflows. Cash flow investing activities, this is the one. From the investing activities, cash flow from financing activities, this is the one. You get an net increase and net decrease in terms of cash at the beginning of period, and then cash at the end of period, and then you got the non-cash from financing activities here. the detail. In terms of learning objective number 2, prepare cash flow statement using indirect method. Cash flow statement is prepared different from other financial statement, not prepared from the just trial balance. Information usually comes from three sources such as balance sheet, income statement, and any transaction data. Accrual concept that is not used since the cash flow statement deal with the cash receipt as well as payments. In terms, there's 4 steps of preparing cash flow such as indirect method. The first one is determine the net cash provided by use in operating activities, convert profit from actual basis to cash basis, and then 2, investing activities, analyze the changes in non-current asset activity accounts. And number 3, financing activities, analyze the changes in the non-current liabilities and liquidity accounts, and prepare the cash flow statement to represent an increase or decrease in cash. And in terms of step 1, operating activities indirect method, convert from accrual to basis. Some revenue expense have not been realized or paid in cash, therefore cannot be included in cash statement. Indirect method start with profit converts to net cash used by operating activities. And this is the first one. The first operating indirect method, profit plus minus adjustment equal to the net cash provided or used by operating activities. Added back on cash activities such as depreciation, added loss and deduct gains for indirect activities, and then analyze the changes of current assets and liabilities by adding the increase in current asset or increase in current liabilities, and deduct the increase in current asset and decrease in current liabilities. And starting with profit, add adjusted this item to the net cash flow projection such as non-cash charges, gain or losses, and changes in non-cash current asset, liability, and accounts. So these are the example of the adjustment required on cash. You're going to add it, depreciation expense. So amortization expense, you're going to add it up. Gain, you're going to loss on disposal of land assets, you're going to add it up. Gain on loss disposal, you're going to deduct. Changes in the current asset and liabilities, increase in current asset, you're going to deduct. Decrease in current asset account, you're going to add. Increase in current liability, you're going to add. Decrease in current liability, you're going to deduct. Okay, this is the indirect method. So when you do that, you're going to do the same thing, operating activities. You got 145,000 profit for the year. These are the adjustment. Depreciation expense, 9,000. Loss on sale of equipment, 3,000. Decrease in account receivable, 10,000. Increase in inventory, minus 5,000. Increase in prepared expense, minus 4,000, because you have to pay. You know why it's increased? Because you have to pay things. Increase in account payable, which is 16,000. And decrease in account tax payable, which is 2,000. Okay, so the total, you got 27,000 here, you got 172,000. For investing activities, analyze the change in long-term asset and investment accounts to determine the effect on the cash, exclude the non-cash transaction, do cash purchase for long-lived assets, cash proceeds from disposal of long-lived assets such as property, plant, and equipment, and changes in the long-term accounts that in purchase of sales and investment.